The idea is to get it to a point where you will not be frightened out of the market. A lot of people made changes to their portfolio because they were worried. They were making emotional decisions, and now they're wondering if they should get back in or not. There was a massive amount of cash that went to the sidelines, or a massive amount of people who cashed out and decided to wait for a better time. So I like to ask, what good is an investment account, an investment plan, or a strategy if you can't stick with it? So some of the things you could do is make sure you rebalance your portfolio. Whereas if you had a certain amount of your portfolio designated to stocks, let's say 70% of your portfolio into stocks, and now that's maybe 80%, and your overall portfolio has gone up, maybe shave that 80% back down to 70%, and maybe bonds were 30%, and now they're 20%, bring those up to 30%. So you rebalance. And you have to also think, now that we've gotten this recovery after such a blowout, crazy market retreat, do you have too much money in stocks? Or did you have too much money in stocks before this? Because if you couldn't wait, if you couldn't handle the pressure, then you need to reevaluate your risk tolerance and have less money in stocks. And you'll just have to accept that when stocks go up, you'll make less money. The issue is we have time horizons until we need our money, until our financial obligations come up. So based on that, have you made any sudden moves that you now regret? It's okay if you made a bad move and you regret it. The idea is to learn from it and move on. The most important thing to know as an investor is to know yourself. That's the hardest thing to know. The other thing you have to take a look at is, do you have enough diversification? I find that a lot of people miss out on what diversification is supposed to do for them. A lot of people believe that diversification means they have a lot of holdings in their investment account. There are 11 sectors of the economy. I'm not saying you need to have exposure to all 11 sectors of the economy, but at least 5 or 6, in my opinion. Now, you want industrials, you do want tech and communications, you want some energy, some financials, some consumer staples, maybe some consumer discretionary, and that starts to give you a diversified portfolio. It's important to have, let's say, small cap, mid cap, and large cap stocks, because you will get diversification. It's very hard to have overlap when you have a small cap exchange traded fund and a large cap exchange traded fund, because the small cap exchange traded fund won't have Amazon and Facebook and Microsoft, etc. It'll have stocks you probably never even heard of. That's how you get the diversification. That's what enables you to stick with a portfolio through thick and thin. Because again, what good is an investment portfolio if you can't stick with it?